Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
VIX is not really a reflection of the level of the S&P, right? It's a reflection of the volatility regime that you're in. And we've gone for years in the past, at or near all-time highs with vol above 15, above 20. Think of the 90s was a VIX 20, 25, 30 regime making new all-time highs. And is how are markets moving? It's the prices of options, and if markets are moving, markets are gapping, markets are trending, and people are buying options, then implied volatility will be elevated. And you think about a world where people are piling into crypto like crazy. There's a huge SPAC mania where pop stars are launching SPACs. Yeah. You've got, stocks going parabolic. You've got Wall Street bets buying, crazy amounts of short-dated call options. That's not a VIX 14 world, right?
Right.
There will be VIX. We will see VIX 14 again, but it won't be with these kind of underlying market dynamics, right? It'll probably require a washout of the crazy, frothy, environment, and maybe that's with stocks a lot lower, or maybe it's just somehow we get a year or two of sideways markets or lower volatility markets.
Welcome, everybody. We're back to talk VIX and options and the overall volatility space today. And while those were typically the realm of only institutional investors over the year, they've made their way into the overall landscape. And when asking around for the best names in the biz to learn about said strategies, more often than not, you'll find the name of today's guest being thrown into the mix. Between his being Vol, FinTwit royalty and work over at QVR, Benn Eifert is among the leaders in the volatility and options space. And he's joined us on The Derivative today to go through it all. Thanks for joining us, Ben.
Hey, absolutely. Great to be here.
I'll say quickly, when we both got on, Ben had the hoodie, and I went and did a quick change into my favorite Fandango hoodie. So where is that? Over here. So
looking good.
Looking good, both of us. I did the same thing. We had Jack Schwager on, and he had a plaid shirt on, and I was like, I want to wear my plaid shirt. This might be my new thing. Just hope people don't have like Armani suits that I have to match up. So
wouldn't know where to find mine after this year, man.
Yeah, exactly. So you're in California, in Bay Area?
Yes, sir. San Francisco area.
San Francisco, where in north of the bridge?
About a half hour south.
South, okay.
Down on the peninsula.
In Silicon Valley area?
Yeah, thereabouts.
Not that far. And you have 2 small kids, right?
3 now. They're multiplying.
3. They're multiplying. You done?
We're outnumbered, outgunned, and hopefully done.
Yeah. I was lucky enough to have the boy and the girl right off the bat and said, that's it. We're covered. We're diversified.
Nice.
And you were Stanford guy, then UC Berkeley PhD, right? So
yes, sir.
California through and through?
Yeah, I spent a little while in DC a long time ago for a couple of years, and then kind of commuted back and forth to New York for a little while. But I've really always been a California kid.
You grew up out there?
Yeah, I grew up in LA.
All right. Who do you like better, LA or San Fran?
I'm a San Fran convert. LA has its cool things. I mean, the beaches are certainly nice and warm and all that kind of stuff. But the thing about the Bay Area is, like, in LA, to get, depending on where you're starting, it might take you like 2 hours to get out of the concrete and the traffic and all that stuff kind of in any direction, whereas the Bay Area is, really kind of built around, all very close in around like some of the coolest, outdoor stuff you could do. So if you like biking and hiking or just getting away from people and getting into the trees or or whatever. The Bay Area is really fantastic for that. Tahoe's 3 hours away. The beach is 20 minutes. It's,
now
doesn't suck.
Your answer to this next question will depend whether I trust you or not. What do you think of Angel Island? That's next to Alcatraz there.
I've actually never been on Angel Island.
Okay, good. Don't go.
Yeah. I mean,
we did the whole Alcatraz tour and we messed up the tickets, but they'll be like, if you go to Angel Island first, and then you can take the Angel Island to Alcatraz, and then they put you on these Disney World parking lot shuttles and drive you around the island, and it's a scratch.
If you could just roll around by yourself or something, maybe that'd be kind of cool.
Yeah, but, I guess if you could hike up it, but it was a brutal experience.
Totally.
And then my last time I was out there was staying down by the wharf or whatever, and my son actually woke up and he's like, I think there's a fire, Dad, and he's shaking me in the hotel room. And I called down to the desk. I'm like, I think my son saying there's smoke in the building? She's like, no, there's a big forest fire. So it's the 2 times ago Napa Valley fire, and there was ash on the cars.
That was nasty for sure.
I don't know how you guys do that day in and day out.
We've had a lot of wildfire issues this last 5 years for sure.
So let's get into your Twitter persona. So DJ D-Vol, where did that moniker come from?
Oh, I think that was David Solomon is a smart and very serious guy who also happens to to be an EDM DJ on the side. And at some point in conversation with some other pretty senior Goldman Sachs people, it turned out that, as you would expect, all of the other senior partners at Goldman have their secret DJ names. Because you just can't be left out of something as awesome as DJ D-Vol, the CEO of Goldman Sachs. And so I think that started to percolate through the broader system. So DJ D-Vol is my not that secret DJ name.
What's his secret DJ name? I don't even know.
He's DJ D-Sol, David Solomon.
D-Sol, got it. I get it. Now I get it. D-Vol, D-Sol.
Yeah. And he's actually got some okay stuff. It's pretty entertaining.
I've seen some of it. That is one of the weirdest things, right? Ever. You would never pay the Goldman Sachs leader to be a DJ.
Absolutely. And I think the board of Goldman Sachs doesn't particularly like it, and they're like, can you just stop doing that? And he's like, no, this is you don't tell that other guy to stop playing golf or whatever it is that he likes to do, and this is what I like to do. So fair enough.
To each his own.
Exactly.
So I love following you on Twitter because it feels very balanced, right? You're showing pictures of your kids and running around doing hikes and stuff. A little bit of snark in there. Show the kids soaking the car. You made me cry a little the other day because you had the kids at the train station, and my son now is 12 and he's overtrained. But those were the days I could just take him on a train, especially in Chicago. Go on the L was worth 2 hours of entertainment.
Totally. That's the thing about kids. The simplest things just make them so happy. But just seeing big trucks or seeing trains or seeing airplanes or whatever it is, and you could just do that all day long.
I love it. And then, but on all the pods and conferences I've seen you on, you're a little more buttoned up. So who's the real Ben Eifert?
Oh, I only button up if I absolutely have to, and I try not to do it too much anyway.
So the Twitter persona is the real persona?
Yeah, the Twitter persona. Well, there's probably a little more snark than the average non-Twitter engagement, but that's because it's a little bit of a forum for that. It lends itself to that.
Yeah. What was the little graphic I saw the other day? It was anonymity plus network effects equals fuckwad or something. It was the Twitter and the internet explained in a nice little whiteboard.
Exactly.
And then out of all your Twitter and QVR duties, do you still teach, or you used to teach the Masters in Financial Engineering?
So I used to teach for several years. It's one of those things that is great to do, and there are business benefits to teaching. You get a really good look at some young talent and stuff, but it's also very time intensive. I haven't for several years. Would love to get back to that at some point, but growing new firms in the earlier days is just pretty all consuming. Plus kids, obviously, as you know.
Yeah, well, that's the best retirement plan, right? Just make some money in the hedge fund and go be a professor. What do you miss most about it? Was the kids or the material?
I think the interaction with the kids and the teaching process is really fun, and one of the nice things about something like Masters in Financial Engineering programs is, it's pretty different than undergrads. It's fun to teach undergrads, but also half of the class is hungover and they may or may not really care that much about what you're talking about. Whereas, MFE students are motivated. They're probably paying for it themselves, both through, hard dollars and through opportunity costs, where they could still be working at, whatever decent job they had last. And, a lot of them come from strong technical backgrounds and know more than you about some set of stuff, whether they be PhD computer scientists or PhD physicists or, whatever it is.
Right. So you're actually learning from them at the same time.
Mm-hmm. Yeah.
Who was the first to call it Masters of Financial Engineering? Because it felt like 10 years ago there was a bunch. They were all kind of doing the same thing, all these grad programs, but they were named different things, right?
Really that's a great question. I don't actually know who the first was. I think, interestingly, if anything, there's probably been a bit of a turnaround in the popularity of that term in favor of more general quantitative finance or something, with kind of financial engineering becoming somewhat of a bad word.
Right, it's got a little negative connotation.
Exactly. You're sort of, but I think, taken, I think the initial point was, again, this was a very practical type of training program where you learn quantitative tools and in real world applications.
And when were you like teaching and delving into machine learning and that kind of big data approach as well, or was it more statistics?
You ask an old guy like me a question like that, and I'll tell you, machine learning is statistics.
Yep. All right.
But with a 25% increase in base salary.
Yeah. and processing speed, right?
That's right.
And so out of that teaching professor kind of thing, is that where your Friday interview questions came from?
I think that's definitely part of it. I mean, the Friday interview question, I don't actually remember what the first one was. I think I was just having fun at some point. But then, people would start to ask like, hey, where's the interview question? And, I think people really like it. And I think part of it, as like I try to describe a little bit, the type of questions that I'm asking. And I think the key thing is, like, if you're looking for, interview questions that are sort of general entry level kind of thing, you're going to get in a coding interview or a quant interview or something. Like, you can buy books for that. And it's kind of standard, like brain teasery stuff or general knowledge kind of stuff. But if you think, 3 years down the line, so what about, the kid who got that job, sat on the trading desk at BNP for 3 years and is now interviewing for a job at a hedge fund, or now, maybe interviewing for another job at a bank or something. And that level of knowledge, again, it's not, it's the kind of thing that just, there isn't a lot of common, you can't buy a book on that. Right?
Yeah.
The way you learn,
if you don't know who to call, you don't know who to call.
The way you learn that kind of stuff, really, there aren't, for the most part, there's going to be relevant things that you can read to some extent, but it's very hard to piece together the context and all the different pieces. You learn that stuff, by sitting next to somebody senior who teaches it to you, right? And that, I think, is the thing people really like about it. Where folks who don't have that senior person who's teaching them, because they aren't sitting in the right seat, can try to do some learning that way. And also the people who kind of are in that seat, but it's 2020 and it's virtual, right? And it's like, you think about how much harder it is to be the junior trainee or the junior mentee in a world where you're sitting in your basement in front of a computer. You're not having those casual interactions and teaching interactions with management or with senior traders. I think it's given people another way of learning some of that, which has been cool.
And you are doing it just out of goodness of your heart, or you get more Twitter followers? Like, what's your end game, or have none? Just
the vast majority of the Twitter stuff is just fun. And a lot of it, to be perfectly honest, happens between when you're a parent, right? Like, you spend some time just sort of chasing your kids around while they're riding scooters out in the in the cul-de-sac or something like that, and then you can sneak some tweets in.
What do you have an example of one of them? I don't have them in front of me, but like, what was a quick one you could give an example of? We don't need to go into the answer, but the question.
Sure. So, take a simple example. I called this a Saturday morning junior trader derivatives interview question. That, all right, on February 20th of 2020, you bought $1 million of Vega notional of an S&P March 20 variance swap at 17 vol. On March 16th, we all remember how fun March was. With the S&P down 10% intraday, you check your risk report. What's your dollar delta on the position? That's the kind of thing where, variance swaps are a thing that if you Google variance swap, it'll come up and you can find academic papers referencing variance swap. But I promise you, none of them are going to explain what it means that a variance swap has a dollar delta the same way that your, stock positions and option
usually they're talking about its start point and end point.
Yeah, exactly. But you better believe that a variance swap has a dollar delta when the market's down 10%, and that your risk report, knows that. And that's the kind of thing, again, that you realistically would only learn in practice, work in a job, sitting there getting taught by somebody. And it's the kind of thing that it's not that complicated. Most of this stuff it's not complicated esoteric math for the most part. It's more understanding, practical, market conventions and applications, and things that you just wouldn't learn in, academia or from reading.
Right. Papers. It's more, in my mind, right. It's more academia versus real life trader, which we see in trend following and all sorts of, right. Of like, you've built the model, you think it's great. Okay. In real world, do you know what it's going to react to each thing? Do you know how those trades are going to go in? Are you just assuming you can get the trade-off when there's a spread, all sorts of
exactly. And that ends up being stuff that matters, as much or more than, did you do the math right or whatever.
But I think it also serves a huge purpose of some guy who wants to be one of those traders, like, oh, okay, this is what it takes. Like, I got to be smart enough to answer this. You mentioned seat. So I want to ask you, and maybe I'll do your bio first, but like you came out of Stanford, out of Berkeley, you got a good seat at big firms, kind of paved the way for you to go. I've been talking to a lot of people, like in the old days in Chicago, you had nothing. You could just come to the floor and learn all those lessons, different lessons, but similar lessons on the trading floor without any pedigree. You could kind of walk in there, like the floor is gone. It seems like more and more you have to have you have to go down the right path to get that seat. So we can answer that after you give your bio or before, whatever you want.
Yeah, I mean, I think that's right. There has been, definitely a shift in, the markets and in the typical background of people being hired into, your classical entry-level roles, right? And a lot of that's been associated with the rise of technology and the rise of quantitative methods. And again, not that everybody is a quant, but the importance of being able to, understand models, to use computers, to write code to some extent, especially these days, right? Where if you look more and more, the most common background, hired into like a trading desk at a bank, it's going to be, engineering majors and math majors and computer science majors from decent schools. And it doesn't mean you have to go to, Harvard or Stanford or MIT or whatever necessarily, although I think like a lot of things, that certainly doesn't hurt. But there's much less of the, kind of high school graduate kind of hustles and then gets that job the way that you used to be able to on the floor, right? In some sense, in the old days with the explosion of finance, in the 70s and 80s, there wasn't really a well-defined skill set that you could be taught in school that was in any way relevant or useful to what the job
so
was.
Why require them to have the degree?
People needed to be smart enough. Depending on what you were doing, there was a good value on mental arithmetic or just being able to keep track of stuff quickly, right? Because you're doing trades and you're writing things down. And I mean, and also, if you're a pit trader, I mean, literally just advantage to being big or being loud or, being able to, have a physically imposing presence, because you're shoving people out of the way sometimes or whatever, right? So it's just a different world versus today when, again, much more, I think, value on technical skills.
Yeah. I remember my first interview with a firm at the Board of Trade, and I came in and I thought I was pretty good at math. And this guy just starts throwing fractions at me like crazy because bonds were traded right in 30 seconds and 10 years in 64ths. And he's like, I can't even remember the questions, but I was like overwhelmed. And he's like, all right, we'll see you next time.
Yeah,
like, exactly. Okay, thanks for playing.
Yeah. Whereas it's funny, but a lot of, it really depends, but a lot of, young, very good traders today probably wouldn't be as good at some of the types of mental arithmetic games that, some of those old traders would, because you don't have to do that. You've got, you use computers, you double check things, you're still fast, but you're doing, in some sense, much more complex things, but therefore needing, systems and technology and computers to do it.
And then you'll see some of the prop firms, right? They'll go hire professional poker players and gamers and things like that, or just have the game theory mindset. I'll teach you the math. I just want you to have the right mindset of how to play the game.
Yeah.
So give us a little background. So after school, went to New York, went to a few different big firms before starting QVR.
Yeah. So, my background, again, I worked for the World Bank out of undergrad in a research division, worked for the chief economist, went back to do a PhD at Berkeley, started out similarly like an emerging markets macro type of research. And then after, about halfway through the PhD, realized I didn't really want to do the academic thing. I wasn't that good at the emerging markets stuff. And, got more and more interested in finance, started picking up some coursework. And so at that point, you don't necessarily want to change your PhD project, because you're like, well, I could just get out of here in a year and a half without too much work, versus if you start all over. So I kept going in that same field, but, built up a lot of side interests in finance, and did some actually my first teaching in the Master's in Financial Engineering department, kind of as a graduate student TA, where the underlying methods. Like I taught the empirical finance class, and statistics, then you just figure out what the financial applications are. Then my last couple of years at Berkeley, I was working first part-time and then mostly more or less full-time by the last year for a hedge fund in Sausalito, as I was finishing up my dissertation. Then first real job after that was on the Wells Fargo prop desk in San Francisco. Wells Fargo prop desk was a great place actually at that time. It wasn't the most famous of prop desks by any means. The Goldman and Morgan guys were definitely.
Yeah. When you don't hear of big prop desks in San Francisco. Yeah.
Yeah, that's right. But the important thing really was that, come 2008, all of the other major banks were under a lot of pressure, and their prop desks were getting downsized, shut down, getting their positions liquidated, just because they were risk for the banks.
Right. Even if they were making money.
Even if they were making money, absolutely. Yeah. Right. Because at that point, you cut any positions that you have that could lose you money, even if they'd been making you money. Right.
Yeah. But you weren't making enough to cover the 80 billion they were losing in the BDS.
Exactly.
Right.
But Wells Fargo was, a very big, very conservative bank that had exactly zero exposure to any of the, structured credit type of stuff that was at the epicenter of 08, right? They obviously had, real estate exposure and so forth. But so the bank was in very good shape. And they made some aggressive acquisitions and so forth because of it. But what that also meant was that, the prop desk was in a position actually of great strength versus other banks. And they dramatically increased the capital and risk tolerance for the balance sheet available for the prop desk. And so, we were a very large force in markets actually at the time. We were one of the, the last bids in the world for distressed, credit assets and all kinds of stuff. I was the quant on the desk at the time. I wasn't the PM. But I built the quant team, built a lot of the risk management systems.
Were they very unquant when you got there?
I wouldn't say that, but they didn't have a formal quant function.
Yeah,
they were all smart, very smart folks who had some analytics and some systems and so forth. But I was the first real quant hire.
Did they have the stagecoach in the lobby like they do here in Chicago?
Oh, the stagecoach was in the lobby, not of our building, but of one of the other buildings. It was pretty funny. And we referred to Wells Fargo as the stagecoach at the prop desk. And so, that was a phenomenal time for the prop desk. We did very, very well. And the bosses of the prop desk spun it out as a hedge fund called Overland Advisors after the credit crisis, kind of with, the support of the bank.
Yeah. And then what were you trading specifically or looking at? Like, what were the main trades going through the desk, or it was far in the field?
So the prop desk was doing a wide variety of things. The home base was corporate capital structure. So think of things like convertible bond arbitrage, cash versus synthetic basis trading and credit. Senior versus sub versus unsecured debt. In the loans versus CDS and bonds.
And wasn't that all getting hammered?
Special situations.
Wasn't it all getting hammered alongside equities in 2008? Or you guys were buying at the lows?
Yeah, I mean, it was definitely choppy right through Lehman, but then the balance sheet and risk tolerance was tremendous, and so we were able to be aggressive when other people were just being forced to sell. Yeah, and that was kind of the key thing. And I did start to run some of the center hedging in derivatives outside of the core corporate asset classes, so things like currency volatility. But I wasn't primarily a trader in that role. Around 2011, that started to change when my old partner John Laughlin joined the firm. So John had been early managing partner at Blue Mountain, and he had started and run the Blue Mountain Equity Alternatives Fund, which was really one of the foundational businesses in relative value derivatives trading on the buy side, in the early and mid 2000s. And John and I got along really well. He joined Overland Advisors, the fund that had spun out of Wells Fargo. And I went over actually to work for John, hired a replacement to run the quant team, and we built a business there doing relative value trading and derivatives, and that was where I learned a lot of the foundational things that have built investment process that we run today at QVR. Many things are very different than they were at the time. That was 10 years ago, but and markets actually look very, very different now. But that was really the early days of these strategies.
And so then somewhere in there said, hey, I'm going to go out on my own, QVR.
Yeah, so John and I eventually started our own fund on the Mariner Investment Group platform called Mariner Korea. That ran for about 3 years. That was a great fund. My main thing, it was built on Mariner Investment Group's infrastructure, and they were based out of New York. So I was commuting between San Francisco and New York every week. And then we had our first kid at the end of 2015, and I couldn't keep that up, and so ended up starting my own thing back out here on the West Coast.
But the miles, right?
I'm a lots of frequent flyer miles, man. Virgin America.
Yeah, not worth it. So give us the elevator pitch on what QVR does, how they look at the world.
Yeah, absolutely. So our investment process, well, I guess first of all, we are a boutique, derivatives, options, and volatility shop. We do a variety of things. So about half of the business is absolute return business that you would think of as traditional hedge fund style business. The other half of the business is a solutions business that you would think of as bespoke, customized mandates from very large institutional investors, where we're doing something specific for them, like hedging the tails of their portfolios.
Got it.
On the absolute return side of the business, it really is an evolution of the same type of thing, that we were doing at Overland and again at Korea, but with a couple of important, updates for the modern environment. So the core of how we think about the world in absolute return land is really understanding derivatives markets and dislocations in derivatives markets that mostly come from the behavior or the actions or the flows of end users of derivatives, right? So the thing that's different about derivatives markets is the marginal price isn't set by two big hedge funds, buying or selling a stock, or the end investor, right? They come from just large organizations that are just doing stuff to use derivatives to achieve their goals. That's why derivatives markets exist, so that pension funds can put on, hedges, or so that, corn farmers can hedge forward their corn exposures and all this sort of stuff. So it's not a market that's dominated by people who are doing sophisticated, nuanced pricing. They're just trying to, achieve their goals. And as a result, sometimes there are large, persistent, or temporary dislocations in those markets that just come about from large trades having to go through the market that they're that need to be warehoused someplace. And it's really a systematic process of understanding and identifying those dislocations, and then creating strategies around them that defines the absolute return business. Go ahead.
Sorry, just quickly, I'll push back on you a little bit, saying absolute return is like other hedge fund strategies. I'd say no, because it's not negative skew, right? Like most hedge fund strategies are a different type or different strategy of just being long equities and still having a big left tail exposure.
Yeah, I think that's fair. I mean, there are many hedge fund strategies that have a large component of some kind of alternative beta to them, right? Where they're giving you a beta maybe to some unusual factor, and maybe it's only partly correlated with risk assets, but there's still some correlation, if not locally, at least in the tails, because there's some leverage to funding or something like that.
Yeah.
Generally speaking, where we operate, that doesn't have to be true, and we certainly emphasize very heavily on market neutrality and managing the tails. The thing that is really new about QVR in terms of how we set up the business and how we manage risk relative to what we had done historically, it comes back to some of the big changes in markets more broadly, but especially in derivatives markets over the last 10 or 15 years. So, if you think back to, the days of the credit crisis, or even the few years after, derivatives markets were really the Wild West. Banks took a ton of risk. I mean, even during the credit crisis, banks were very aggressive. They held a lot of inventory. They traded very aggressively. A fund like, a hedge fund like ours could comp out a dozen banks on a very large, complex transaction, and they would show up. They would make good prices. They would make them in size. They would make tight markets, and you could trade almost anything that you wanted to at or very close to mid-market. Finding the axe on the other side, finding somebody who was, willing to be aggressive, and as a result, you could have an investment process, and you could execute that process, very efficiently. Taking some counterparty risk because a lot of those trades were OTC, but it was a market where that execution process was facilitated very heavily by the risk-taking activities of banks.
And before you go to the other side of that, let me dig into that. So why do you think they were taking so much risk? Were they incented to, like in their I mean, I know we had Dodd-Frank and it kind of made that go away, but right, the banks didn't want to lose tons of money. Did they just believe they weren't going to lose money?
Certainly there was some element of that, and in general they were making tons of money throughout most of that process, right? And
they were using VAR instead of a more meaningful metric to measure their true risk.
And even when you look at 08, many of the businesses at banks made a ton of money and continue to make a ton of money, but there were certain areas that lost absolutely catastrophic amounts of money, right? In particular, in the synthetic credit derivatives area, where risk was just so extremely mispriced. And some banks recognized that earlier than others and moved to mitigate those risks. Other banks weren't really able to do that. But generally speaking, the business of facilitation of clients across a spectrum in derivatives markets is very profitable. But what I think one thing, it wasn't necessarily profitable for those banks to be doing those aggressive trades specifically with smart relative value hedge funds.
Yeah,
it was profitable on average for them to be trading aggressively with lots of types of clients, right?
So they might be selling it to a pension who thinks it's a good idea, but they don't know the math exactly correctly or something of that nature.
Yeah, that's right. And so there was another version of your question is, well, why were they willing to be aggressive in the business in general, but why were they willing to be aggressive in the business with smart relative value hedge funds that appeared to actually make money?
It feels like if you beat them enough times, they're going to take their ball and go home, right? Like, hey, I'm not trading with him anymore. He kills me every time.
Yeah, and this was always actually, would come down to fights between traders and salespeople, right? So generally speaking, the smarter traders would understand that and wouldn't really wouldn't be that excited to trade with, the well-known hedge funds that
on the bank desk.
On the bank desk.
And the salesman saying, no, that's a good client. Trade
that's right. But but salesmen and senior business managers push very hard to have the volumes up, right? So salespeople get sales credits, whether or not the trade makes money, and they sure like that. And senior business people like to see their bank at the top of the league tables, because their view is, it's not just that trade. It's not just that client. It's an entire business franchise. And being number one in the entire business franchise matters. It means that the corporate clients are going to come to us. And like, maybe we lost some money, trading with, these 2 or 3 hedge funds, but it's small potatoes compared to the money that we're making because we're perceived as the biggest in the business in equity derivatives or in, rates derivatives. I think and there is some truth to that.
Would your former colleagues at the Wells desk trade against you, or did they know better? They all moved to Overland.
They were not. Wells Fargo was never a very aggressive derivatives trading house. So generally speaking, they weren't somebody that you wanted to call for a price.
Yeah, that would have made a better story though if they're like, I'm not trading with that guy. I used to sit next to him.
Yeah, exactly.
Sorry, so I interrupted your story. So that's the way it used to be, and now the way it is now.
Yeah, absolutely. So that really started to change very fast when Dodd-Frank started to be fully implemented. I mean, Dodd-Frank itself dates obviously to the days of the crisis, but there wasn't not much changed when the law was written. It was kind of phased in implementation over time in terms of, stress test requirements and capital requirements and, liquidity coverage ratios and all this sort of thing. And what you started to see very quickly around 2013 or 2014 was, banks really losing that risk tolerance, right? So, old cowboy traders getting moved out, smart, young, less experienced, but very well overseen, traders getting moved in, getting fired for, taking too much risk and losing what historically would have been relatively small amounts of money. Regulators actually, getting risk reports in much greater detail than they used to, and looking at them and asking questions about them, all the way down to, the VP level traders running portfolios, much tighter and much more sophisticated constraints on stress test losses. And the result of all this was, first of all, the intention of all this was, the regulators viewed 2008, correctly to some extent, right, as a systemic banking crisis caused by the fact that banks were taking and warehousing so much risk and made some very bad bets.
Yeah.
And so the antidote was, don't let them do that.
When it may have been more correctly warehousing concentrated risk in a few areas, right?
Yeah, I think that's right. And so what you got was the evisceration of the risk-taking capabilities and inventory warehousing capabilities of banks, and that's something that was discussed very intensively all through. This isn't sort of something that we noticed. I mean, in fixed income markets, people were talking about this to no end, and there was lots of discussion at the time about the potential liquidity implications, but it really took a while for this to work through, and those, you only got hints of how bad liquidity could be when markets came under stress, right? And the result of that was, over time, if you were an aggressive relative value hedge fund trying to quote banks on, big variance swap trades or big forward starting option trades or something, the number of banks that would price it shrunk. The banks that would price it in a fifth of the size that they used to and 5 times wider than they used to, right? And so if you tried to run your business the same way, it just wasn't going to work, because you'd be, you wouldn't be able to take enough risk, and you'd be paying a lot more to get the risk on, and it'd be much harder to get the risk off, and you were much less nimble, and this whole thing. I think you saw that affecting a lot of people in the space, and you saw returns struggling across.
Would you agree that was across the whole space is why hedge fund returns came down?
Yeah, I think that certainly in our space you saw that very clearly. I mean, I think that there's a variety of things that were playing into like overall hedge fund industry returns over that time. I think you can also fairly point out that the aggregate hedge fund industry grew very fast, and arguably way too fast after 2008, 2009, right? Just AUM and the size of funds, grew astronomically. And to some extent, if you're really in alpha strategies, there's only so much capital you should be able to put to work in alpha strategies before you start to dilute those returns or start to take just more and more hidden beta type of risks, right? And to your point, selling hidden tails and things like that.
And what's the quote? There's more hedge funds than Taco Bells, I think.
Yeah, something like that sounds about right.
Yeah.
And so, I think the natural evolution of that from our perspective was when we were building QVR, our view was the underlying problem was not the activity levels in derivatives markets being too low. I mean, if anything, that was the opposite, right? If you look at volume metrics in listed options in equity, for example, first in index options just exploded parabolically in adoption and volume over the last 10 years. Single name options lagged a bit, but then the last couple of years have actually kept up or caught up very dramatically with explosive retail participation. The underlying issue was just bank facilitation of markets for hedge funds and for aggressive relative value players. And so our thinking was to just cut banks out of the loop, right? And not exclusively. I mean, we're happy to talk to banks if they have inventory, they have axes they want to unload. I mean, we're happy to have those conversations, but that's not our primary business in terms of execution. We took the long view and built the technology and the systems to be able to work, to participate in that tremendous volume on listed markets, to be able to work into and out of positions that we want, on the screen by acting like one-sided market makers, where we're dynamically best bid in the market for everything we want to buy, dynamically best offer in the market for everything that we want to sell, and we're liquidity providers as we work into that process, as opposed to quoting a bank and saying, hey, I want to buy, this is what I want to buy, what's your offer, and hoping that there's a good offer there. So that was a big change.
In theory, that gives you worse pricing. Like in the past, if you could have gone around to 8 banks and found the one sucker, for lack of a better term, and now you have to just get the worst offer and the worst bid on the screen, right?
Yeah, I mean, what it does, right? In the old days, when you could, and it wasn't necessarily that you found a sucker and bought way below mid or anything, but what it did mean is that you could have a trade you wanted to do, have the exact structuring of that trade and the risk targets of that trade, and you could just go do it, right? Or maybe if you're big enough, maybe you have to do it 2 or 3 times or something, right? But it's, you have exactly the risk.
Right now you
say done and you're done. Right now you have to say, here's my target, and then you have to spend some time working into that. And maybe it's minutes, or maybe it's hours, or maybe it's days, and you're going to have sophisticated systems for managing the process over which you leg into all that risk and making sure that you're not exposed to, getting too many of your shorts filled before your longs and all this kind of stuff, right? So it's more complex. But importantly, it's not, it means that you're able to, work trades over time and not necessarily be paying bid-ask spread, right? You're not lifting offers on the screen. You're showing bids and people are hitting them.
And so then coming back, and because you're in the vol space, I feel like you get lumped in as tail risk. Like, talk to that a little bit. You're saying, no, we're absolute return, but is the structure such that you're looking for convex payoffs?
Sure. I mean, there's a few different things, right? So first of all, there's 2 sides of the business. We do very explicitly have mandates for, huge institutional investors where we structure tail risk portfolios from them. That's separate from the absolute return hedge funds side of the business. On the absolute return hedge fund side of the business, we are the mandate is absolute return, not to be bleeding away carry and hoping that the world blows up, or positioning for the world to blow up, right?
Yeah.
That said, you can broadly speaking, you can imagine 2 different types of absolute return trades that have different shapes of the distribution, right? I mean, one might be a trade where there appears to be a dislocation and there's some risk reward for that, and it's a symmetric thing. Maybe it's a 55% chance of win and a 45% chance of loss, and it's $1 if you win or $1 if you lose, and there's some positive return to that, and it's symmetric, and that's fine. But another type of positive forecast expected return trade is one where you're just buying a really cheap option that 10% of the time, if something really bad happens in the world, is going to make a bunch of money, and 90% of the time has some very small positive carry or something like that, right?
Yeah.
That's or zero positive or zero or flat carry, depending on how the trade is structured, right? So if we can find significantly, what we perceive to be significantly positive expected return trades that happen to be very asymmetric, that's great too. And generally speaking, in very quiet market environments with suppressed risk premium like 2017, 2019, you tend to find those kinds of opportunities. There tend to be somewhat less of those kind of opportunities in the wake of crisis events when, shorts have gotten blown out.
And is it a go anywhere? Like where you would look at like palm oil or something of like, there's positive carry there and I have this huge right side asymmetry?
Yeah. So, this portfolio is one where it's the investment process is not showing up every day and kind of like looking at the news and thinking about all of the entire universe of all the possible things you could trade and do and sort of what's going on. That's a little bit more of a macro guy thing. We're very process oriented. We have, a set of strategies that, all tie back to something that we fundamentally understand as traders or as market participants, but that, we've built a big set of quantitative research around, and we have a process around for how do you understand this dislocation? How do you measure it? How do you know if it's big or small? How do you assess the expected returns and the risk? How do you think about that? And then we allocate risk across the set of strategies that we have in a portfolio construction process, right? So we do also have an opportunistic bucket, and when there's something that presents itself that's very compelling, that doesn't fit, within our more formal strategy set, we definitely will look. But it's not a process that's first and foremost kind of going around the world looking for kind of some odd new thing that we've never seen before. Because usually, to get really comfortable with, a decent sized trade, you need to be pretty familiar with the technicals of that market, with the products, with the participants, to make sure you're not missing something and to make sure that you really understand what's going on. And I think that's very much more our approach.
So I won't hold my breath waiting for the Eifert QVR kills it in palm oil. So would you call it more of a quantimental then? I don't know if you like that term or what that even means, but right. So it's the whole process, but then you're basically using not discretion, but you're saying we're going to check that versus reality before we implement the trade.
Yeah, I think that's a reasonable way of thinking about it. I mean, I always think of there being a spectrum, right? From at the one end, very opportunistic, one-off, gut feel type of investing, to at the other end, fully automated, back to front black box, RenTech type of investing.
Yeah.
Almost nothing in derivatives is at that end, right? Other than small, electronic market making and high frequency, like a Citadel Securities or something, because derivatives markets are too multidimensional. Data.
But by derivatives, you mean more options, right? Not like single futures, right? Because there's a lot of it in plain.
Yeah. I mean non-linear derivatives. Yeah. Futures absolutely, or there's plenty of purely systematic stuff. But when you're thinking about strategies involving options, or certainly like light exotics or anything like that, it would be very, very rare to see fully automated front to back type of strategies. Again, there will be a few specific exceptions, but it's pretty rare. Certainly in multi-strategy type of approaches like ours. So we at the end of the day have a strong process that makes. We have a strong quantitative process that makes investing much more efficient, because again, these are repeatable themes where we have data that helps us to track and identify what dislocations there are, how big they are, that quantify how we think about the returns and so forth. But we're always going to be evaluating all of that data and then making incremental changes as we think is right. And we're going to be thinking about things like, is the data clean? Are there any issues with data inputs? Are there new dynamics at play here that our model isn't really capturing, that are important risk dynamics that we think you have to take into account? Has there been a regime shift? Or is this apparent dislocation not really a dislocation? It's actually a big macro theme that could have important implications for changes in markets. And we don't want to be we don't want to be betting against macro guys who are buying a bunch of options. We want to be taking the other side of price insensitive end users of derivatives. So there's very much a qualitative process that sits on top of the systems and the models.
And then the process lets you be able to be out in the cul-de-sac with your kids on their scooters too, right? So you're not sifting through all the data every day. you mentioned in there somewhere of like the players and the flow, and kind of just mentioned if there's a big dislocation. So I've heard you talk before about Pension X. I don't know if you want to mention names here, but Pension X came in and had all this to sell, or this hedge fund blew out. Like, talk a little bit about how, was that much bigger in the old days, or you still use those kind of, it's not necessarily inside information. I'm going to get us in trouble here, but right, it's not on front page of Bloomberg either. So
sure, yeah. I mean, we definitely like to, particularly if there's something that appears to be a very large dislocation and we're going to take a lot of risk on a trade, we like to understand what's going on and what's causing the dislocation, right? And usually large dislocations are caused by large transactions.
And we're talking like VIX Mageddon, like February 18 or something.
Yeah, I mean, think about February 18. Of course, you could have, looked at, so that's a great example. So let's talk through that, right? So, let's say you have a set of quantitative models thinking about, dislocations in the VIX futures. So what are you going to notice in, January of 2018? You're going to see that, VIX itself is at 9 or 10, which is, historically very low. You're going to see that the VIX term structure is extremely flat, right? So when you think about the short volatility trade that many people were piling into in the run up to through 2017 and the run up to 2018, you can make money on a short volatility trade either by having implied volatility go down more, or by having time pass and there be term risk premium in the curve and contango in the futures curve, by which you sell at 12 a month out and then it rolls down to 10 by the time you expire. If volatility is already at an all-time low and there's almost no term risk premium in the curve, there's essentially no way to make money on a short volatility position. But there's some really nice opportunity to lose a lot of money.
That right? Target manager was making money, right?
Exactly.
And then
and then it was a rough ride. Yeah. So any type of reasonable quantitative analysis, from a historical perspective of the VIX term structure is going to tell you, something's wrong here. There's no risk premium in the VIX term structure, and also there's huge asymmetry in where it could go. And you could also look, in the data, because you could see this, and you could see that the size of the VIX ETNs was quite large, right, on the short side. So there was a lot of retail money in XIV and in SVIXy, and trying to short double levered ETFs. Something that you could model, but you really did need to understand fundamentally as a trader, was the way that whole ETN complex worked, and the way that it has to rebalance itself, right? So the way that either an inverse ETF or a levered long ETF or levered short ETF, by that matter, they all have to trade in the same direction in response to a move in vol, right? So if vol is higher, they all have to buy vol, and if vol's lower, they all have to sell vol. And if you understood all the magnitudes involved and the positioning involved, it gave you a whole lot of confidence that there was the potential for an extremely asymmetric squeeze higher in volatility if there was some kind of market sell-off, right? And it didn't have to be that big of a market sell-off, because from vol of 9 or 10, it's kind of a fallacy. A lot of people will think about percent changes in VIX, right? And they'll think, 50% is like a huge percentage change in VIX. Well, if VIX was at 30 and it went to 45, that's a pretty darn big move. Could happen, but it's pretty extreme. For VIX to go from 10 to 15,
right, is $5,000 per contract.
Yeah, is not a big move at all. And that, you can imagine that happening on a 1.2% S&P sell-off or something like that happened on some minor bad news. So the potential for, if you understood all of those pieces, right, you probably should have a quantitative model that assesses that term structure relative to slope. But if you really understood the positioning there and who you were really on the other side of and what mechanical forced buying that your counterparty had in an event of a market sell-off, that would give you the confidence to have a very large position, that was one way or another along the front end of the VIX curve, and in an absolute return context, probably hedged with something else.
Okay. But then you've also have had intel on, right, like these pensions are all selling tons of volatility. Maybe that's available in all their report, investor reports. I don't know. But how does that all play in? You just see that as the overall landscape? Yeah,
well, I suppose there's two distinct things, right? One is understanding big structural patterns in flows, right? So you're kind of alleging to, for example, the huge rise in institutional, call overwriting and cash secured put selling.
Yeah.
And that's been, just kind of starting from say 2012, 2013 onwards, that was just kind of a steady freight train. Where a ton of that stuff is just, if you're a public pension, generally speaking, you disclose everything that you're doing, right? You disclose every search, you disclose every time you hire a manager, what the program is, you see the pitch book, right? And none of that stuff is in any way secret or proprietary. You just sort of see it all happening, and everybody knows about it, and everybody talks about it, and the market makers see all the flow, and so forth.
Well,
so
everybody on, right? Within your small circle of everyone in that space, like the rest of the world doesn't know about it until it's right in the Financial Times.
Yeah, no, that's right. A secondary thing is, when things are getting exciting and unusual flows are hitting and big players are doing unusual things, then market participants are talking about them. And, that's a little bit more like the other thing that you said. That's not kind of general knowledge of the types of things that have been happening and the patterns over the last bunch of time. That's, hey, there's this manager that usually just sells various forms of S&P volatility, and now they're coming to us and they just sold 1 million March VIX upside calls, and then next 2 days later they covered those and sold twice as many of the 10 strike higher calls. Right.
Whoa.
That's the kind of thing that when you are us, you're seeing the price impact of those kind of trades, and they're affecting your models, and your models are saying, hey, there's a big dislocation here, what's going on? And when you and so you want to find out what the big flows driving that are. And generally speaking, we're talking about a March 2020 example, but again, it's a small community, and it's a community that shares information, not necessarily in an inappropriate way, but shares market color about transactions that are happening, because it's beneficial to all of the sophisticated market participants to understand what's happening and why and how it's impacting.
And they don't want to see their client get blown out or something either. Like, hey, be careful, that guy just puked out of those positions. And
no, that's right. And so it's certainly something that we are traffic very actively in, is an understanding of what's happening in the market.
And this may fit, but I read somewhere you equated all this vol activity to the Force being out of balance or something. So I'm a huge Star Wars fan. So talk some Star Wars to me. What do you mean by that?
I think that was a quote maybe from a Corey Hoffstein chat that we were having, but. It's this notion that, again, if you think about what a long short equity manager is doing, they're trying to be the smarter guy than the other long short equity manager and buy Facebook when the other guy thinks it's not a good trade, and short Netflix
or even private equity for that
trade, or whatever it is, right? So it's sort of a zero sum game over being having the right trades on. Whereas when you think about derivatives markets, again, derivatives markets exist because of the end users of derivatives that have needs that they're trying to achieve, right? So, pension funds that are trying to put on hedges, and corporations that are trying to hedge their jet fuel price exposure, and all this kind of stuff, right? And there's, real economic value there to those end clients, and those end clients and end users are paying a pool of market impact and bid offer spread into the market, to achieve their goals, right? And sometimes those flows are idiosyncratic and balance out and so forth, but sometimes there's big themes in those flows, and they're very persistent, and there's a bunch of different, the call overwriting and put overwriting flow, that we talked about is a good example where, the clientele is one way in that trade in huge size, or what, particularly from say 2014 to 2018, 2019. And so that creates a dislocation, because all else equal, just market makers are constantly getting hit on the same thing over and over and over again, and they have to adjust their prices, and that changes the landscape. And the market needs secondary market participants that can understand those dislocations and then warehouse that basis risk, right? Take down
basically come inside the market maker's widening spread.
Correct, because the market makers, can't just indefinitely warehouse an infinite amount of that kind of trade, right? They can hold some, but especially in this environment, right, they can only hold a limited amount of inventory. At some point, they have to recycle that into the market, right? Right. So the first thing a market maker does when a pension fund hits them on 10 million vega of short dated calls is they're gonna buy those calls, and they're gonna sell out some 2-month calls or some 3-month calls or something to kind of proxy hedge the volatility exposure. Yeah. But then when another guy comes in that size and another guy comes in that size, right, they're gonna have to be recycling that risk out into the market, and someone else is going to have to be buying that exposure and then figuring out what's the hedge and figuring out what's the trade structure and what are the risk factors, what kind of a portfolio risk return does that create, how do you do it, right? It's only that, it's that kind of balancing of the force act, right? Where sometimes there are temporary big dislocations that are caused by, big trades going through, and someone has to step in and kind of restore balance there. Sometimes there are these big, more thematic dislocations that require folks to hold basis risk in some size or another over long periods of time.
Do you only come in
balance?
It's the dark side providing the imbalance. You're coming in as the light side of the force.
That's right. We're the good guys.
So that touched on something I wanted to all this retail call buying. You just tweeted out today the call option contracts bought. I got the graph here. Right, it was at by retail small customers 1 to 10. I don't know what that means. They do 1 to 10 contracts.
1 to 10 lot transactions. Yeah.
Yeah. So it's not necessarily a small customer, but they're small orders.
That's right. And most of that is going to be small retail flow. It will be mixed up a little bit with the small number of firms that that are batching out orders into very tiny sizes and things. That's a pretty small percentage of the market, though. But generally speaking, when institutional customers go to do option trades, they trade 10,000. They trade 10,000 on the floor or whatever in S&P.
So the graph you shared was 3 million at the start of 19 to 6 million at the start of 20 to 20 million to start 21 here. So up almost 7-fold in 2 years. So to your point, these market makers can't keep just churning that along and warehousing that risk, right? Yeah. And that's the whole concept of their delta hedging. It's driving all these gamma flows. It's driving the market higher. Like, how does this all end? Does it end poorly? Can it keep going indefinitely? What are your thoughts there?
Great question, and one that comes up a lot. So yeah. I think it can't go on indefinitely, for sure. It can go on longer than people think. So I think
stay solvent.
Yeah. The couple of things to point out, about this flow. So a lot of it is very short dated. So it's weekly, 10 delta calls or weekly 20 delta calls. A lot of it is associated with, groups on social media that are coordinating trade activity, right? So it's not necessarily individual, humongous individual accounts, although there are some, large individuals in those communities, but it's, tens of thousands or hundreds of thousands of accounts following on a trade, from a heavily followed influencer in a community, for example. And it's often concentrated in technology stocks, in momentum stocks, and narrative stocks, in meme stocks, to use a word from the kids. And it's option buying, which means that it's inherently limited loss, right? So this is something that the kids are getting right. Most retail activity in options the last 10 years was concentrated in option selling. There were a lot of people telling you had to do call overwriting, you had to be an option seller, go on Tasty Trade or anything like this, right? You always hear about X% of options expire out of the money, blah, 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 blah. These guys get that you buy options, and one key thing, right, is you'd think, how can this last? And then you have these, pretty decent market corrections, right? And you think, they lost so much money. And the herd of call option buying folks, do lose a lot of money on those moves. But unless they're literally 100% of their account is in, weekly long option premium,
right? In the next buy, they keep rolling.
They don't lose all of it. Maybe they lose a third of it, or maybe they lose half of it if they're taking way too much risk. But these sharp, sudden corrections that then steamroll right back into rally, they lose some money and then they get back in and then they make it back and then they double it, right? So in order to really end that cycle, it takes not just a big sell-off or a sharp sell-off. It takes an extended period of time where the markets are chopping sideways or down, where they're buying options and losing all their premium. They're buying options and losing all their premium until it's too much and game over. And that will eventually happen. But yeah, it's hard to put a time frame on that.
Running a lot of FinTwit would have you believe though that it can't happen because the market makers have to prop up the price so their gamma stays, and they don't have to, which works until it doesn't, right?
That's right. It works until it doesn't, right? So the effect is an accelerate. The effect of option gamma is an effect of acceleration, right? So it's when retail buys a lot of short-dated upside call options, if equities are moving higher, if then market makers and people who are warehousing the short side of that have to buy more stock to stay neutral, right? And that effect is strongest near the strikes. And for very short-term options, it's really a very dominant effect, only very close to strikes, right? Option gamma is kind of inversely proportional to time. To a function of time, right?
Yeah.
And so when there's upside call buying, what that means is there's a lot of acceleration effects to the upside. And then if those calls keep getting replenished, there's continued acceleration to the upside. But there can be negative fundamental events that can happen and selling forces in those stocks that come from, the many other folks that own a lot of stock from big institutions and so forth. And that can absolutely totally overwhelm, retail call buying and, push markets lower. But
because if I have 50 billion to buy, whatever, 10 points higher, 10 points lower, I have 50 billion to sell.
That's right. So it works both ways. And if let's take the example where there's a bunch of upside call buying and the stock goes up and rallies up, and now there's a bunch of those call options are in the money, but they haven't expired yet. If you then start to get a sell-off, dealers have bought a lot of stock to hedge their positions. Now they have to sell that stock right back out to, rehedge on the way down, right? So it does cut both ways. It's more pronounced to the upside rally because it's upside calls getting bought. So at least at initiation of those positions, that gamma's to the upside. But it's not a force that can overwhelm a lot of big institutions selling stock. It's just actually big institutions have been buying stock the last 6 months, right? I mean, we got through March. There was a lot of selling kind of towards the lows, but after that, people have been re-risking, and then they've been looking at, bond yields at all-time lows, providing, no or negative forward expected returns. And you've had big institutions taking, 60-40 to 70-30 to 80-20, just rotating into stocks because they just don't like their fixed income positions. They don't view them as offsets, right? And that's been a lot of net buying, right? But if you got a fundamental backdrop that convinced a bunch of big institutions that they needed to be sellers, that would overwhelm, the effect of Wall Street bets trying to buy some calls.
We were on Adam Butler of Resolve. We were saying that target dates funds are eventually we'll see like 150-20, right? Because to keep up to get the yield they need, they're gonna have to go above 100.
Yeah.
Which will be fun. And so do you give much credence to like the GEX index and DIX index and all this stuff?
Well, dealer gamma is a powerful and important phenomenon. The original GEX index is sort of a toy model that I think doesn't really capture it very well because GEX is constructed essentially just as just the gamma of call open interest minus all the gamma of put open interest, right? Which would in some sense correspond to if you thought that every call option in the world was sold to a dynamic hedger by a client and vice versa, which is sometimes it's a okay first order approximation of things sort of, and other times it's really not. I think right now it's really not.
I think you've said that a lot of this call buying is also from people who were nervous about the rally and not totally convinced and buying calls instead of outright stock, right?
Yeah, exactly. So, flows generally are much more balanced now than they were pre-COVID. There's a lot of net option buying from institutions. There's net selling and net buying in different buckets. It changes during, at different points in time. You can try to have a more sophisticated model than GEX that tries to capture that somewhat. It's hard. You still have to deal with all kinds of complexities. There's a whole OTC market that you don't see. You have to deal with, all kinds of things that you can't do perfectly. But so, again, the original kind of naive GEX index is what it is. I wouldn't assign too much weight to it. Again, it's not that it's a good idea. It's just
so don't just follow it on Twitter and sling trades around.
That's right. Don't sling trades on anything you see on Twitter.
On Twitter. And then the flip side, which you just mentioned and we talked about before, are these institutional pension vol sellers coming back in the market at all?
Yeah,
like it seems like that was a big, especially for tail risk funds, they were getting all this supply of cheap convexity, and with those guys gone, maybe that's why VIX is still at 25. Or
there's different sectors of flows, right? So there's your vanilla call overwrite and put cash secured put sell strategies that very large pension funds and institutional investors participate in, and that stuff it got a little bit smaller, but it's for the most part it's business as usual, right? Because these are very, very large institutions that took 6 years of meetings to kind of initiate these types of strategies. And there's some line item someplace, and they don't necessarily do a bunch of complex attribution of the performance of those strategies. They're kind of disappointed with their performance, but it's going to take them another 4 years or 5 years or something to downsize them, right? That's just how that space works. But there's other pockets, right? So there's the large scale retail and high net worth part of the systematic vol selling space. So you could think of that as the biggest players there were Harvest, for example, and UBS Yes, which were trading huge size iron condors. And there were many, many smaller players, and that space has been eviscerated because performance generally was kind of flat for the most part for the last several years before March, and then they got hit really bad. Or actually before even 2018. 2018 they got hit really bad. The downtrend started really after 2018, and then continued now. So that was a big player that's taken out of the vol selling space. So that's contributed. And then there are retail structured products globally, which is more of the selling of long-term crash risk in the form of structured notes. That business again briefly dried up after March, but then has come back with a vengeance because we're back to raging equity markets, and a lot of the higher, so the coupons are bigger, and retail investors love those things again. So that tail risk supply is coming back online.
And a lot of the knockouts didn't get hit, right? One last question on the vol space. What do you attribute this, VIX? Last time we were at all-time highs, we were at 14 or something. Now we're at whatever we are, 20 something. Like, do you think this is an echo from March and it's going to last years? Do you think we're in a new range? What are your thoughts? I know VIX isn't something you probably put a lot of faith in, but just as a general gauge of the volatility.
Yeah, I mean, VIX is not really a reflection of the level of the S&P, right? It's a reflection of the volatility regime that you're in. And we've gone for years in the past, at or near all-time highs with vol above 15, above 20. Think of the 90s was a VIX 20, 25, 30 regime making new all-time highs, right?
It has call prices.
The key question is, how are markets moving? Yeah, exactly. It's the prices of options. And if, markets are moving, markets are gapping, markets are trending, and people are buying options, then, implied volatility will be elevated. And, you think about, a world where, people are piling into crypto like crazy. There's a huge SPAC mania where pop stars are launching SPACs. Yeah. You've got, stocks going parabolic. You've got Wall Street bets buying, crazy amounts of short dated call options. That's not a VIX 14 world, right?
Right.
There will be VIX. We will see VIX 14 again, but it won't be with these kind of underlying market dynamics, right? It'll probably require a washout of the crazy frothy, environment, and maybe that's with stocks a lot lower, or maybe it's just somehow we get a year or two of sideways markets or lower volatility markets.
But still, the realized is much less than the implied, right? So we can say all that stuff's happening and causing the implied to be high, but the realized for 3-4 months has been much lower. I think it was a record spread in there in December. or 10,
yeah, so
10-year records?
So December we had close to close realized vol of 9, but if you look at like intradaily measures of realized vol, it was much higher than that. So it happened to be a month where we had a lot of, every intraday sell-off was bought hard, and we had lots of days that were down 1.5% or down 2.5%, down 2%, and kind of came back to only down 50 bips or something. That's not necessarily a reflection of a low level of volatility. That's, a small sample, effect, right?
Yeah.
Same thing, look at, realized volatility was 9 on a close to close basis, but realized correlation was extraordinarily low. We had huge moves under the surface in individual companies and sectors and in factors. And it happened to kind of average out, right? We got some days where the index didn't really move, but energy was up 7% and
right.
tech was down 2%. That's not a low volatility regime. Yeah, that's not a low volatility regime, right? That's a realized volatility is a very dynamic thing. And when you look at 9 volatility in months in 2017 or 2019, it was every day stocks moving 30 basis points or 50 basis points, and single name vol very low, right? It's just a very different regime.
So that's a good way to kind of explain your overall thoughts on the market, right? Like a simplistic vol arb kind of strategy would maybe be saying, hey, implied's above realized, I'm going to sell vol here. So way more complicated.
If you were to look at is trailing realized versus implied, everybody kind of thinks that, right? Look at whether that's a good signal for selling volatility or buying volatility over the last 5 years. It's absolutely zero signal, right?
Yeah.
If not negative signal, because ultimately implied volatility is not as dumb as you might think. It's reflecting a lot of things about forward-looking expectations and what's going on that close to close trailing realized volatility isn't. In the old days, 10 or 15 years ago, derivatives markets and volatility markets were smaller and a lot less efficient, and those kind of signals did work somewhat, but there's just absolutely no evidence that they add any value today, right? So saying implied just recently it looks like there's a lot of volatility risk premium, doesn't help you. Now you can ask questions about, is the volatility risk premium regime that we're in now and likely to be in over the next 6 to 12 months different than it was pre-COVID? And it's a hard question to answer definitively, but there's some good reasons to think there's been at least some shift there, right? Because a lot of the you did blow out a lot of the sketchiest selling activities, and there have been more balanced buying flows on the other side.
But even some of that hedge selling has not worked, right? So if I'm reading the implied, it's overpriced, I'm going to sell it. I'm going to sell S&P at the same time, or buy some proxies or whatever, or sell some proxies. Like that hasn't really worked of late either.
Yeah, that's right. I mean, if really we've had a big risk rally, right? So, if you had, and everything depends on timing, but I mean, if you had come up with some kind of a hedge trade where you just shorted volatility in March and then you shorted, equities against it as kind of a proxy hedge, and you just held that, that would have been very choppy and wouldn't necessarily have done that well, right? Because we've had a monster rally. And any type of hedge that you would have wanted to do for a short volatility position would have underperformed dramatically. And it just depends on, okay, what did you hedge it with and what kind of hedge ratio and so forth. But
that reminds me, everything depends on timing. That's my favorite joke. I'll amend it for our audience here. Why can't vol managers tell good jokes? Bad timing.
That's very true.
All right. We'll let you go here in a second, but well, just 2 quick questions. What are a few things most retail vol traders get wrong?
Yeah. So I think, certainly one thing retail vol traders.
I'll interrupt you quick and say, go listen to your Corey Hofstein pod, because you went through a lot of this, but give me one of those. Yeah.
Yeah, absolutely. I mean, I think part of it depends on whether we're talking about today's retail vol traders versus 3 years ago, right? So
let's talk today.
Yeah. So today's retail vol traders are very aggressive. They're very different than 3 or 4 years ago, in that they're mostly option buyers. I think they aren't very good about thinking about risk and sizing, right? So one really important thing, if you're buying stocks, it's not unreasonable if you've got a reasonable, decent amount of risk tolerance to say, look, I've got $100,000 in my account and I own $80,000 worth of stocks or $100,000 worth of stocks, right? Because a really bad experience, you might lose 20% of that or 30% of that. I mean, more if it's really, really sketchy stuff, right? But if you're buying, weekly out of the money options, barring markets that just go up in a straight line every single day, most of the time you're just going to lose all your money that you put down on those options, right? And so, what I tend to see, a lot of evidence of retail traders, saying, okay, well, good, I've got $100,000 account, I'm putting, I've got my trade this week, I'm putting $50,000 into it, right? Maybe that's less than you would have bought of stocks, but you have to translate the risk you're taking between that position and a stock portfolio, right? And it's orders of magnitude higher per dollar of premium or per dollar of spend, right? And people have lucked out to some extent because of just the incredible rally, and more often than not you've won on that 10 delta call option, right? But that's not the steady state affairs of the world, and you go broke very quickly putting a meaningful percentage of your your net worth into short-term out of the money option buying every week. And so being careful about understanding how much risk you're taking and how to size positions, I think is important to being able to survive more extended market corrections, and to be able to to be able to play again next time.
And then do you think, I feel like even they're going to be buying 30 delta calls and it goes their direction, but the vol didn't come in and they lose money on it. Like, I don't think they have that all figured out either.
Yeah, I think that's definitely another thing is, a sophisticated understanding of option pricing, obviously is a lot to ask for most retail traders, but you have a lot of cases where there's big crowded, buying of the same kind of thing in a very high volatility name. And not a lot of understanding that, you could buy, if you're talking about GameStop moved 70% today. So that's a hard, example. But if it had, GameStop was, some of those options, upside call options might've been 150 or 200 vol. That worked out because GameStop was up 70%. But if it had only been up like 8% or 12%, you might well have lost a bunch of money. And said, what the heck? Like on Robinhood, it says buy a call means bet that the stock goes up and make money if the stock goes up. And that's literally what it says. And by the way, it's like, shocking that you can kind of get away with that, right? Right. And when in practice, it's like, okay, how long dated is this option? How fast is the time decay? What's the slope of the skew curve? And how is the option going to ride on it as the stock rallies? Is the implied vol going to come down after the event? All that kind of stuff. And you can very easily, get the right directional outcome on a short-term out of the money option trade, but still lose all your money or still not make nearly as much money as you thought. And that can be a complicated, calculus.
I called it before, 3D chess on the water with sharks with laser beams on their head.
Exactly.
There's a lot of components there. And one more, I keep saying that this time I'm honest. Before we get to our favorites, then that's back to personal. But what do you think some of the professional vol traders overlook? I won't say that they get wrong, but that they overlook.
Yeah, absolutely. I think that professional vol traders can be overprone to heuristics, especially heuristics that there was really a good reason for some period of time. So I'll give you an example. After 2008, there was a tremendous amount of risk premium, in particular in S&P options and S&P volatility, because S&P was really, and still is, the kind of the go-to, most liquid, most benchmark, place to hedge if you're worried about something. And 08 was so bad, everybody remembered how terrible it was to get caught unhedged or get caught short convexity. And so there was this very persistent bid specifically to S&P vol, and that lasted for a good 4 or 5 years. And you saw a lot of managers figure that out and put on a lot of trades over those 4 or 5 years that were short S&P volatility and long something else. It might have been long single name volatility in like a dispersion context. Yeah. It might have been long European volatility or Asian index volatility, where there wasn't that persistent bid for, and where there was some structured product selling flow on the other side. And those trades did quite well, for an extended period of time for good reasons. They were sensible trades. Then what you started to see was, that persistent bid for S&P start to fade. A lot of the the pension funds, participation in tail risk funds, drop off after so much money got evaporated, trying to hedge at very expensive levels over, the 5 years after the credit crisis. And then you saw more and more selling flows, and eventually S&P index volatility, especially, further out the curve, it got very cheap. But I think there were quite a lot of folks that, again, for so long, it was a good trade to buy European vol and sell S&P vol, or buy anything and sell S&P vol, that many people kind of got stuck in that as like that's a good trade because it's just always a good trade. And they came up with narratives about why it was always a good trade, and kind of overstating a little bit the structured products impact and, all these other kind of things. And you saw, I think, a lot of people stay in those kind of trades, for years when they stopped working, and then when they started losing money and still stay in them, and then get totally crushed on them in 2020. And it comes again from habit formation, right? When something just every time you click the mouse it works. After a while you stop thinking about why it works and you just expect it to pay you.
Taleb's turkey, right? He's every day until that 1001st day, 1001st day, 1001st day. How do I say that? Cool. Let's go into, we'll finish up with some of your favorites. We can go quick fire here. Favorite Bay Area restaurant?
Oh, geez, that's tough. I mean, the uninventive one would be Spruce, which is, I think, the best high quality restaurant in San Francisco by a long shot. Really love that place. The best, out of the blue, thing, probably Rangoon Ruby in Palo Alto. Outstanding Burmese food. Cheap as well.
And I see some of your tweets. You're like in some places that look like they have no walls. There's just like outside. It looks nice. I actually got engaged in a sushi restaurant in Palo Alto. I can't remember the name of it. My wife was a consultant and out there, and I surprised her.
Nice. Good work.
I'll have to look that up. Yeah.
Jinsho is one of the good sushi restaurants in Palo Alto. Steve Jobs used to go there all the time back before he died.
That may have been it. Favorite FinTwit follow?
Oh, man. Favorite FinTwit follow? I'm going to have to think about that for a second.
All right, we'll skip over that one. You can come back to that one. Favorite investment book?
Favorite investment book? I would say, actually, it's probably only loosely an investment book, but The House of Morgan. Kinds. But The House of Morgan is, really a chronicle of, the Morgan family and dynasty and the businesses that grew out of that, going way back to like the 1700s, and a story about the evolution of the financial system, globally over that process. And I think it's you just learn a tremendous amount from it.
Does it have when the U.S. came to him for money? Right? Wasn't he?
Yeah, absolutely.
Today's dollars, was he a trillionaire? Or what?
You think of it's funny, right? Because you'll get a lot of people who are very anti-central banks, but JP Morgan was basically the central bank before that, right? It was just a more informal process.
Right. Would you rather have this single guy be the central bank?
Exactly. Or have some kind of government process for it? Yeah, exactly.
And are you a California wine guy? I had Jason Buck on here, said he lives in Napa. I said favorite Napa wine. He's like, I don't like Napa wines. Like, you're gonna get in trouble. But so,
oh no.
A, are you a California wine guy?
Yeah, I'm absolutely a California wine
guy.
guy.
Some of your favorite labels out there.
Totally. I mean, so there's your classic stuff like Silver Oak is fantastic. You don't find a lot of people who disagree with that, but I'll give you some. Again, less known stuff. So I really like California's Infidels. I think it's a strong comparative advantage, and there's a shop called Matsoko that just does a fantastic job. Has some of the best Infidels that you'll ever get. A somewhat recent discovery that's funny and has been chatted about a bit on Twitter is convexity, right? Like some of the old LTCM guys actually have a wine label, and it's actually decent. I expected it to be very overpriced for kind of the kitsch value of the story, but it's actually halfway decent too. So I didn't realize got a case of that the other day.
I saw the pictures. I didn't realize they were LTCM guys.
Yeah, it's Merriweather himself, a couple of the other guys.
That's a book. Someone needs to write.
I don't think he's there like squishing the grapes or anything. But.
Right, but someone needs to write the follow-up of those guys still left with some pretty good chunk of change, right?
Oh yeah.
After they almost blew up the world, but that's a story for another day.
Absolutely.
Favorite kid activity?
Favorite kid activities?
With your kids, not when you were a kid, but you can tell me when you were a kid either.
Totally. Favorite kid activity is probably riding bikes with the kids. In part because there you get to have like a fun kid activity that's a daddy and son or daddy and daughter thing, but you get a little bit of exercise from lose a little bit of the dad bod in the process. So the kids, we started out with the 6-month-old in the front seat and then graduated to like the rear seat thing. And now Thomas is 5. He's almost a little bit too big for the rear seat, and we're going to have to move to like the kind of tandem trailer type of bike thing.
Yeah, or like some of these Dutch designs where they've got all the crazy stuff.
Yeah, exactly.
When they get a little older, this summer we took my son out to we were in Snowmass, and you do down the ski hill with the jumps and the bank turns and everything.
Oh yeah,
that
just
was
sounds
awesome.
epic.
Last question, then we'll let you go. Favorite Star Wars character?
Favorite Star Wars character? God, I mean, it's so uninventive to say Han Solo, but
not at all.
Yeah,
he's
like
a legend.
Yeah, he's a legend, and you just sometimes you just got to be the decisive action in the heat of the moment. Like you can't overthink stuff. You just gotta if you got a plan, whatever, but you just gotta be decisive and respond. And certainly through markets like March, again you have your process, but there's ultimately you're going to be stressed in every way, and you just gotta you just gotta show up and let the adrenaline flow and get it done.
That could be the new QVR motto. Never tell me the odds.
Never tell me the odds. There you go.
All right. Did you think of your FinTwit guy? We'll let that one go. I don't want to have you make any enemies.
Oh God, I'm like scroll. The problem is that there's just
too many good ones.
There's just a lot of really good and really funny people. It's too hard to pick one.
All right, we'll leave it alone.
And then I'll have like 10 people being.
Yeah, what the hell? I thought I was your favorite.
Exactly.
Awesome. Well, this has been fun. Sorry we went a little over, but hopefully it was worthwhile.
No worries. Absolutely, man.
And when things open back up, we'll be sure to come out and visit in San Fran.
Sounds great. Looking forward to it.
All right. Thanks.
Take care.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.